What's going on, everybody? My name is Zach Hartley and welcome back to another weekly watch list video. In this one, we're going to walk through the market conditions, a couple of the indices, and I am going to talk about where I think there's an opportunity in the market. Then we're going to finish off with a couple of stocks at the top of my watch list. So let's jump right in. Okay, first up here, we have the NASDAQ index. As you can see, we broke out of some previous resistance here. We almost got up to this sort of 14,500 mark here, maybe 14,700 mark. And then we came back down to previous support right here. It's going to be interesting to see what happens if this trend continues or if we break down through support. S&P 500 looks fairly similar. You can see a very similar pattern. We broke through previous resistance. We got rejected at the next level of resistance, and now we have come back down to support. And the Dow Jones actually looks a little bit more bearish. We got rejected several times at this 34,500 level right here. We broke through it and we've already fallen through support, but it does look like if you wanted to, you could call this a new trend right here. So once again, we are at sort of an inflection point where we are either going to bounce off of support or we're going to break down through, and that is probably going to determine the direction of the week. Now, when it comes to Bitcoin, we've basically consolidated since we saw that pretty large drop from 29,000 all the way down to 26,000. Since then, we've basically traded sideways. And when it comes to the oil and gas market, WTIC or West Texas Intermediate Crude is usually where I like to look for kind of the benchmark to the industry. And as you can see, we did have a little bit of a pullback there, but it has looked pretty strong in the last 24 hours. Now, when it comes to earnings here, we have a couple of companies that are reporting earnings. We are going to talk about the banks here real quick. Scotiabank and BMO are reporting this week. TD and RBC reported last week. We also have CrowdStrike and Polestar and Lululemon all reporting this week. So a couple of exciting companies coming out. Now, when it comes to market conditions, there's a couple of things that we need to talk about. First of all, interest rates are the big topic in the market right now, and they are having some significant impacts. Mortgage extensions right now are absolutely surging because people cannot afford higher, basically monthly payments towards their mortgage. And so instead of paying more and dealing with that higher interest rate, they're just extending it out over a longer period of time. And if you look at TD Bank, you can see that 48% of their mortgages are for more than 25 years, and that is up 35% year over year. And so pretty crazy numbers here. RBC is looking very similar, maybe not quite as high as this. I think they're in the 36, 38 range somewhere, but still, these numbers are kind of scary to think that TD, one of the largest Canadian banks, half of their mortgages almost are for over 25 years. And most people don't sign up for any mortgages longer than 25 or 30 years. So that is concerning here. High interest rates are putting more pressure on consumers with debt. Anybody with a mortgage or credit card debt or high payments right now, you're probably feeling the pinch. Now, when it comes to the Bank of Canada and the U.S. Federal Reserve and deciding on those interest rates, the Bank of Canada is going to be making their next decision on September 6th, and the U.S. Fed is going to be announcing their next decision on September 20th. So September is going to be a big month for determining what is going to happen with interest rates. Also right now, globally, on the kind of market condition side, China is struggling. They're having some major issues with real estate right now, and every article I read basically says that they're struggling to get back up and running and maintain their growth from pre-pandemic. Also, it's basically a tough market for a lot of companies right now. If you've listened to the earnings at all, you'll know that consumer softness, you'll know that inflation, you'll know that rising costs are really starting to hit a lot of these companies. And there's only a couple of industries right now that are doing extremely well. One of them is artificial intelligence, but I feel like everybody is talking about that. The other industry that I like right now is actually insurance. Now, the reason I like insurance companies is because you pay a premium every month to your insurance company, whether it's for your house or your life insurance policy or your health insurance, or maybe it's for your mortgage insurance, whatever it might be. You pay a monthly premium to that insurance company every single month. And that money gets saved up for insurance payouts so that when something goes wrong, they have the money to cover that larger expense. However, all of that money in the meantime, while it is not being used to cover that large expense for an insurance claim, it gets invested, usually into very, very safe and low risk investments. But what's interesting about this is that as interest rates go up, those investments that these insurance companies are making start to generate a better return. And it means that those insurance companies are going to generate more profit. Because imagine this, if you are one of the larger insurance companies and you have this giant pool of money that is saved up in case of insurance claims or big emergencies or natural disasters, And pre-pandemic, you were making 1, 2, 3% on that money. And now that interest rates are 5 and 6%, you can make maybe double the interest rate. Well, all of a sudden, your business hasn't really changed, but now you're making twice as much money on your investments. And that is very, very exciting. And that is one of the reasons why I think insurance companies are doing well and could do well in the future. If you look at the NASDAQ insurance index right now, you can see that we are fairly close to all-time highs, which is nice to see. And if you look at Intact Financial, I'm looking at the Canadian version right now, but this is one insurance company that is fairly well diversified. They're one of the largest. They pay a very reliable dividend, and they're hovering or basically consolidating right around their all-time highs right now. And so what I like about this is if you see the breakout to the upside, it's going to be very clear and very apparent. And if you see the breakout to the downside, you can set a stop loss to manage your risk accordingly. Or if interest rates start to decline, you can get out of this without losing too much money. And so I really like Intact Financial. For the long term, it pays a steady dividend. If interest rates stay high for an extended period of time, Intact Financial is going to continue to make more money, and it's going to be very clear when this stock falls below support. So I really like this as kind of a high interest rate play for anybody that wants a medium to long-term investment. Now, one company that I don't like at all, and one company that I've talked about on this channel before, is Foot Locker. Foot Locker sells products made by Adidas and Nike and Air Jordan and a bunch of other brands. And all of those brands are deciding and starting to sell directly to consumers. And it pushes Foot Locker out, and it makes you wonder, why would I buy from Foot Locker if I can just buy directly from Nike? Especially considering that they're even in the same mall a lot of the time. And so Foot Locker is a business that I do not like at all, just from the kind of macroeconomic and competition standpoint. Last time I talked about them, they gapped down by about 20%, and just recently they released their quarterly results and they gapped down by about 30%. I think this is a company that is sort of on its last life right now. I don't think it's going to be here in 5 years. I think it either gets bought out, I think it goes bankrupt, I think somebody steps in and takes all of the locations and the inventory. I think something happens to Foot Locker in the next little while, because this company just looks like they have a huge uphill battle ahead of them. And as you can see, ever since I started talking about this company, all it has done is go down. It's down 50% since my June 4th video, and I was talking about it before then as well. So keep that one in mind, especially if you like going short. Foot Locker is my number one short position right now. Next up here is Tesla. Tesla is a super exciting company, and they're back on my radar. I got in, I got out of Tesla. I should have sold at 300. I didn't. I sold out lower than that. I think I either broke even or made a little bit of money on Tesla, but it wasn't a good trade. But it's back on my radar, and the reason it's back on my radar is because we have got 3 consecutively higher lows right here. We've got a bit of a pullback, and it looks like we have a bounce off support. So all of our technical indications are starting to line up. We also have a crossover of our MACD, and it's looking like Tesla could be bouncing off support just based on price action. And so I like Tesla. It's back on the radar. If we can break above $240, I'm probably back in it, looking to ride it up to 300 or above. Probably put a trailing stop loss on it this time and not get greedy. I got greedy last time on it, and it wasn't the right call. Last stock that I want to share with you here is Brookfield Renewables Corporation. I am thinking long-term here, and I'm thinking about my portfolio when I get into retirement. What companies do I want to have? One of the companies, or at least a couple of the companies that I want to own, are renewable energy operators. The companies that operate the solar panels, operate the wind farms, produce the energy, and just continuously operate and pay back the profits to shareholders. Those are the kind of companies that I like, because I think that's the energy of the future, and I'll probably do well with it over 40 or 50 years. One of the companies that fits that criteria is Brookfield Renewable Corporation. I talked about NextEra Energy in my last watch list. You can take a look at them if you're interested. But this is a company that does something very similar. They are a renewable operator. They're paying a 4.7% dividend already. And I am watching for the breakout here of basically $40. You can see we came down to $37 right here at the beginning of 2023. We are testing it again right now. I like the company. I think they're doing well. I think the dividend is going to hold this company up, and I like the long-term vision. So if we can break above $40, I am a buyer of Brookfield Renewable. Now, If you're interested in learning how to put together your portfolio and actually analyze these companies and these stocks and understand what you're doing, I have tons of courses on Skillshare. It is completely free for 1 month, and you can take all of my courses. You can take any course on the platform, and it's basically like Netflix, but you get access to some of the best information that the world has to offer. Like I said, all of my courses are on there. Some of them have over 14,000 students and over 400 reviews for you to take a read through. There's over 2 million minutes of watch time that has been spent on my stock market fundamentals course, and I promise you it will be the best free resource that you can find online for learning how to trade and understand the markets. If you get any value out of this video though, please remember to click that like and subscribe button, and I sincerely appreciate it. We'll see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.